Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax strategist, and today we're tackling tax strategies for the future, preparing your business for potential legislative changes. If tax headlines make your eye twitch, you're not alone. Laws move, sunsets arrive, and budgets need revenue. Our goal is to keep you 2 steps ahead. I'll decode what's changing, show you how to model outcomes, and share practical levers you can pull so your cash flow survives whatever Congress does. Why does legislative volatility matter? Because timing and structure drive your tax bill more than almost anything else. Rate changes shift, whether it's smarter to recognize income now or later. Expiring deductions can turn yesterday's great idea into tomorrow's audit magnet. States chase revenue differently than Washington, so a federal tweak can ripple through payroll, sales, and income taxes. Markets also react. Financing costs, valuations, and exit windows move with policy. If you plan scenarios today, you'll choose confidently under pressure, instead of reacting with expensive last-minute decisions and mistakes. Let's start with an example of 3 big sunset items that loomed after 2025. First, the Qualified Business Income Deduction, Section 199A, could have vanished for many pass-through owners. If your marginal rate rises while the 20% break disappears, S-Corp wages and guaranteed payments deserve a fresh look. Second, the fee 10,000 SALT cap would have expired, but not all states will land the same way. Your deduction profile may improve or simply change form. Third, the estate and gift tax exemption was scheduled to drop by roughly half. High net worth owners should consider gifting SLATS and valuation discounts now while rates cooperate. Now the business mechanics. Bonus depreciation was fading. 60% in 2024, 40% in 2025, 20% in 2026, then gone. Section 163J. Interest limits use EBIT, not EBITDA, reducing interest capacity. R&D costs must be capitalized and amortized. 5 years domestically, 15 for foreign, if Congress didn't reverse it. Net operating loss rules limit offset to 80% of taxable income, with indefinite carry forwards but tighter usage. Each rule pressures timing. When you buy, borrow, build, or recognize income matters more. Forecasts don't need a crystal ball. They need structure. Build best, base, and worst-case models for each entity and for each owner. Vary tax rates, phase-outs, and deductions, and run short, mid, and long-term views. Layer in cash flow, distributions, debt service, and covenant tests. Then define decision rules. If rates rise X, accelerate income or defer. If bonus falls, do we pivot to Section 179? If 199A sunsets, how do payroll and profit allocations change? Document triggers so you can act mid-year confidently tomorrow. Entity choice may look different post 199A. S-corporations can manage self-employment exposure via reasonable compensation, but wages reduce QBI when the deduction exists. Partnerships offer flexibility for special allocations, basis step-ups, and exits, but members face self-employment and NIIT nuances. C-corporations offer a flat rate and fringe benefits, yet double taxation and exit taxes loom. Model 3 horizons: operations, distributions, and exit. Don't forget state taxes and built-in gains if converting. A wrong time switch can trap value for years. Timing works in any climate. If you expect higher future rates, accelerate income now and defer deductions. The opposite if rates might fall. Compare Section 179 to bonus. 179 can target specific assets and create or increase a loss. Bonus is automatic, but fading, and may be limited by 163J, or taxable income. Place assets in service before year-end with invoices, delivery, and ready-for-use evidence. Consider prepayments under the 12-month rule. For liquidity and bracket control, use installment sales, partial dispositions, and charitable planning with appreciated assets or donor-advised funds. Accounting methods are underrated levers. Cash basis often accelerates deductions and defers income, while accrual can help with matching and bank reporting. Many small business taxpayers under $30 million average receipts may use cash, avoid unicap, and choose simplified inventory, including treating inventory as non-incidental supplies. Form 3115 allows partial method changes, and Section 481A adjustments to create one-time deductions or spread income. Review capitalization policies, repairs versus improvements, maintenance, and the de minimis safe harbor. These elections convert gray areas into documented, defensible positions. Credits cushion turbulence. If you perform qualifying development, plan the R&D credit alongside capitalization, tie time tracking, project lists, and nexus documentation together. Builders and contractors should evaluate 179D deductions for energy-efficient commercial buildings and 45L credits for qualifying residences. Coordination with designers and certification is critical. EV and charging incentives can complement fleet strategy, but run the math on basis reductions. Don't miss hiring and training credits, plus state programs. Missouri's works for tech, manufacturing, and community development. Credits rarely last forever. Bank them while available. State strategy matters as much as federal. Elective pass-through entity taxes can sidestep the SALT cap for many owners. In Missouri and numerous other states, elections have deadlines and payment timing rules. Confirm eligibility, owner agreements, and basis tracking before you elect. Map nexus and apportionment before hiring remotely or opening new markets. Sales, payroll, and property still drive most formulas. Review sales and use tax exposure, especially marketplace facilitation, software, and installation services. If you find liabilities, consider voluntary disclosure to cap look-back periods. Retirement plans are deduction engines and wealth builders. A well-designed 401k with profit sharing can shift significant income, especially with new comparability formulas. Add a cash balance plan for larger, steady profits. Coordinate with S-Corp reasonable compensation or partnership guaranteed payments. Revisit Roth versus pre-tax. If you expect higher future rates, Roth contributions or conversions may win. Otherwise, load pre-tax while brackets are generous. Align owner W-2 wages and K-1 profits with plan design, payroll taxes, and 199A math. Don't forget catch-ups and timely deposits. Documentation turns good planning into audit-proof planning. Use an accountable plan for reimbursements, maintain mileage logs, and keep calendars for travel and meals. For home offices, track square footage, exclusive use, and utilities. Document reasonable compensation with comparables and a duty analysis. For R&D, gather project charters, time records, and uncertainty narratives as you go, not months later. Close the books monthly, reconcile. Clean books let you pivot quickly and support elections, method changes, and credits when the landscape shifts. Protect cash while you plan. Use quarterly estimate safe harbors, generally 100% of prior year tax, or 110% if your AGI exceeded thresholds, to avoid penalties while legislation evolves. Set a tax reserve in a high-yield account so required payments don't squeeze operations. If a rule change is unclear, extend your return to buy time. Extensions are a filing strategy, not an audit risk. Update forecasts monthly. Capture mid-year wins and avoid liquidity traps created by large purchases or backloaded distributions. Thinking about selling or buying, start tax diligence early. A quality of earnings process should test state nexus, payroll exposure, and method changes that impact EBITDA. Identify deferred revenue and 163J limits affecting debt capacity. If you need an S election, plan timing and late relief options. For former C-Corp, watch the built-in gains tax window after conversion. Clarify asset versus stock deal preferences, allocation under Section 1060, and indemnities for prior liabilities. Tax readiness can shift valuation points in your favor. 3 quick case studies. 1. A contractor accelerated equipment purchases to capture 60% bonus on assets, used Section 179 on smaller tools, and sidestepped 163J limits. 2. A professional services firm adopted Missouri's PTE tax, synchronized quarterly payments, and increased deductions while aligning owner basis. 3. A startup compared S-Corp wages to partnership flexibility. With a potential 199A sunset, they stayed partnership, prioritized capital raises, and used accountable plans to reduce payroll drag. Action checklist. In 30 days, gather last 2 years of returns, year-to-date financials, fixed asset listings, debt schedules, payroll reports, and ownership agreements. Map exposures. QBI, SALT 163J, R&D capitalization, Nexus, and sales, use tax. Identify accounting method and credit opportunities. In 60 days, build scenarios, pick timing levers, outline Section 179 and place in service targets, and prepare PTE and retirement plan elections. In 90 days, implement purchases, elections, payroll changes, and documentation routines, fund estimates and reserves, and schedule quarterly reviews so changing laws become agenda items, not emergencies. Document triggers and responsible owners for action. When should you call a pro? Red flags include multi-state operations, international activities, rapid growth, losses with debt, related party transactions, compensated owners, M&A or planned gifts and trusts. Complexity multiplies when you change methods, restructure entities, or pursue credits. A seasoned advisor will build your scenarios, quantify options, and monitor bills as they move, so you act before rules take effect. Bonus: professionals speak IRS, banks, and buyers and sellers. The right partner pays for themselves by preventing mistakes and capturing opportunities you never knew existed. That's a wrap for Tax Smarts Unlocked. Today we covered looming sunsets, modeling best, base, and worst cases, timing deductions, entity design, state moves like Missouri's PTE, credits, documentation, cash flow, and exit readiness. The takeaway: build scenarios, set triggers, and keep books clean so you can act fast. If this episode sparked questions, bring in a pro. I'm David Robson. Thanks for listening, and plan forward.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.